Back in 2015, when you saw that rout, remember the Chinese economy was also seeing a lot of weakness. Given some of the measures that they took post that, both on the currency, both in terms of bond issuances, today they're actually sitting on a huge stockpile of debt, which is why this entire move on the currency is making markets even more jittery with regards to what could possibly happen. Let's go across to Arvind Sanger, who's also joining us this morning. Arvind, just when we thought perhaps they were going to be reaching closer to a deal or at least to a dialogue that was going to be constructive, we've actually got China, as it's being quoted, showing its claws in response to that 10% tariff that the US has imposed and devaluing its currency. It's sent markets reeling. What's the big takeaway at this point, Arvind? Are you viewing this in terms of the kind of impact it's going to have on the global currencies and the fact that central banks are now going to have to pause given the current environment? Everyone was looking at a dovish tone. Now everyone's paused given that the impact this could have on their economies as well going forward. What's the kind of global collateral damage we could see on the back of this?
Well, first of all, I would say the exact opposite of what you just said on the second. Global central banks are not going to pause. It means that they're going to have to cut more. Secondly, we're on an all-out trade war. I don't know, you're talking about yesterday's news about US tariffs causing China retaliation. But the latest news is that now US has labeled China a currency manipulator, which is going to get China's back up even more. So I think we're in a tit-for-tat raising of tensions, and central banks can only do so much in terms of cutting, which clearly they will have to keep doing. The Fed was hoping that they were going to be one and done for a while they wait to see how things develop. But the speed with which the trade war things are moving, I think Fed and other central banks will be forced to do whatever they can to try to offset the damage. But I think the risk to global markets and to global economies is growing dramatically. And that has nothing to do with the central banks. That has to do with the trade system coming under severe pressure, and that causing huge volatility in currency, and therefore volatility in equity markets. So I think we're in a period of unprecedented global turmoil, and I'm not sure this is a time where there's any clarity on how far this is going to go or how far the markets will sell off on this.
So as an investor, Arvind, one wonders, especially in India, given that the Nifty has already fallen, 11% from its record peak, what is it that you do? Do you get into capital protection mode? Do you start booking out of your ICICI banks, HDFC banks and Bajaj finances? Or do you keep that shopping list ready? Because, at some point, sooner or later, the markets will bottom out. And should you be starting to buy the decline?
Well, at some point here, India is going to get, certainly the mid-caps have gone to close to historical buy points in terms of relative valuations. And even when you look at bond yields to earnings yield in the Indian market, we're getting close to buy points. The only thing that I worry about is that the Indian economic outlook is, the US and even China's economic outlook is, US is quite, reasonably strong point from where it's starting. China's from weaker point, but India is starting from a very weak point in terms of how badly the economy is reeling right now. So I think, yes, from a pure valuation standpoint, as long as one believes the E side of the PE ratio, things are getting interesting. But I think the real challenge in India is right now, how badly is the economy reeling, and what, if anything, is being done to help turn that around. And I think that's the only thing that gives us pause, although the other indicators are starting to flash. That maybe the market's getting close to oversold levels.
India always was more like a growth market. We may argue about valuations, we may argue about the recent fall in mid and small cap stocks, but my understanding is that the reason why Arvind Sanger came to India in the first place is because he liked the demographics and he liked the fact that Indian companies were growing at 15-18%, which was enviable. But now that growth has got compromised, what happens?
You hit the nail on the head. The unique thing about India is we could find growth companies which were, able to deliver good returns with, good growth with good returns. And I think now we're finding it much harder to find, certainly in the mid-cap space, and maybe with a few exceptions of large caps, but those large caps are very expensive, any value associated with that growth. So I think what we are looking for is where valuations get attractive and where we can see companies that even in this period of extreme pain for the economy can show growth. And that's much harder to find. And therefore, we don't have a big basket out there saying, bring it to me. I would love to buy these companies, because the growth side of the story is completely missing in action in India, right?
Using the bad news in autos or consumer discretionary or durables to your advantage to buy, because if monetary policy is strong and supportive, inflation in India is benign, you never know, post-festival season or maybe by January, maybe by early next year, demand could come back. And if real demand comes back, that means markets will stabilize 3-4 months before that.
You're right. I mean, eventually this kind of decline of 30% plus or 20% plus in the auto sector and other sectors cannot continue. And so I think, this is the struggle. We are getting close to historical valuation points. We have a huge decline behind us. At some point here, one has to take the plunge and make the bet that growth will recover at some point. Just from a pure cyclical standpoint, the consumer is not going to keep declining spending at the rate at which it's going on. And there doesn't seem to be any big train wrecks looming in terms of, a lot of the over-leveraged sectors and over-leveraged companies have already gotten washed out. So therefore, in some of the well-managed, well-capitalized, but growth-challenged companies, there are opportunities here. But when you ask me in the global macro, do I need to rush out and buy? I don't think so, but I think India is getting close to buy points from a historical standpoint. And the lesson of history is that at those points, you make a long-term bet, even if the short-term growth dynamics look somewhat missing in action.
Okay, Arvind, great to have you on the show. Thanks so much for staying up late and joining in today.
Thank you.